Hello, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. I want to welcome everybody to the Daily FX walkthrough. Going to get started in just a moment. What I'm going to do tonight, I'm going to walk through the latest technical report by Jamie Setley. So let's get started. I'm going to go ahead and pull up DailyFX.com, and usually the first thing I do when I get to DailyFX.com is I'll scroll down to click on Jamie's technicals, as I am primarily a technical trader. For a more fundamental view of the market, you might want to check out Terry Belkis's reports, which are also excellent. But let's go ahead and click on Jamie's report, see what he has to say. It was a wild day in the market, and let's see what he has to say in terms of the synopsis on top. The Eurodollar rallied over 2% today, second largest one-day rally in its history. However, bulls should exercise caution at the current juncture as potentially strong resistance at 149 looms. So, if we go forward, if we scroll down a little bit to get a little more in-depth in his analysis, the Eurodollar experienced its second biggest gain in one day ever, rising over 2%. The pair is just below what I think will be strong resistance from the 50%. That's 50% fib of 160.40 to 138.77, and the 821 high above 149. So basically, you don't have to understand Elliott Wave fully to see that Jamie clearly is expecting resistance at 149, and the wave structure does confirm this view. So let's go ahead and pull up the chart of the Eurodollar, so you should be able to see this at home. And let's highlight that 149 area. And what is interesting about that area, if you give me one moment here while I add the lines, is that it is also that previous high over here. Excuse me, I'm having a little problem with the line. Of 149.66, and then if we go ahead and add the fib levels, if you give me another moment here, we can see that the 50% fib also coincides with that previous high over here, which is 149.66. So this is a convergence of two major technical levels. Moving forward, also, if you want to take a slightly longer view, we could see a potential head and shoulder pattern setting up, which is usually the sign of a larger reversal, and that might make sense only because we can see the impulsive nature of the recent decline, which could be a trend-changing event. What could be happening now, as Jamie has been saying, is that this is just a counter-trend rally, and that there will be resistance, and then the overall trend should continue in the future. But that's something that we should look for Jamie's reports each and every day, just in case there's a change in that. There is an alternate count that calls for another for a fifth wave rally back above the 160 area as well. So it's very important to keep in touch with Jamie's reports each and every day. But right now he was very clear, and he always will be, in terms of where the support and resistance levels will be. So again, you don't have to fully understand every aspect of Elliott wave analysis to derive the benefits from Jamie's report. So right now, looking forward, zooming ahead, how this might play out in real time, because that's what's going to happen. Obviously, I'm sure this has happened to many traders out there. You've known that there's a resistance or support at a certain level, and the market kind of shook you out, and you weren't able to participate in the move. So what I would suggest is to obviously, at this point, wait for prices to reach that 149 level. Keep an eye on Jamie's technical reports. Keep an eye on this blue line here, which again is 149.66, the previous high, as well as that 50% fib, which in my experience has been a very reliable fib level for the Eurodollar. I recall last year two very significant bounces off the 50% fib. So that's something we can look at. And wait for prices to get close to this area. Ideally, what we would like to see is a large candle wick, like a wick like this down here, the skinny part of the candle, penetrating briefly above both of these lines and then having prices close back beneath the level. So this is something that could unfold over the next couple of days. If that were to occur, then we might initiate a short trade with a stop back above the high of that candle wick. Again, that's just a scenario looking forward, and it's something I like to do in terms of viewing the market, having certain certain scenarios in my mind, and if they unfold, then I might get a little aggressive. If they don't unfold the way I think they're going to unfold, I still might take a shot at the trade, but I'm going to decrease the size. The most important thing in terms of trading is to keep your risks small, and usually that means taking a smaller position size, making sure that you stay in the game so you're able to participate in the larger moves. A common mistake for a trader might be to short exactly at 149 with a stop, let's say, at 149.50. You might get a spike on that day to 149.75, will be stopped out of the trade, and then prices will do exactly what you thought they were going to do. So again, that's why it's very important. You might give up a little bit in terms of trying to, get that perfect entry, but it's very important to let these candles close, and this could be a very significant turn if it does occur, and that's why, again, I'm using the daily charts as opposed to my last few reports when I was using the hourlies. Again, my name is Matt Russell. I'm an FX Power Course instructor here at FXCM. Thanks for listening.